In this video, I want to examine why small cap stocks can soar in bull markets and struggle in bear markets. Why do they struggle in bear markets? And why do they perform very well in the bull markets? That's the concept behind this video. So I want to start with number one. There is outperformance in bull markets. In a typical bull market, as we saw from the topic, small cap stocks tend to outperform. And so you're considering, higher growth potential. There is that higher growth potentials. And so small cap stocks generally have more room to grow compared to large cap stocks, just like a small child. A little child has more room to grow compared to a youth. A youth is almost like getting to the limits of his or her growth, But the small child can still have room for growth. Same thing is applicable to small cap stocks. They still have room for growth. So during bull market, investor sentiment is typically positive. And smaller companies can benefit from increased consumer demands, favorable economic conditions, as well as access to capital. This can lead to a rapid revenue growth, higher stock price, and significant returns. Once there's there's an increase in revenue growth, turnover growth, growth in sales, and all things being equal, once it gets translated into the bottom line, into profits, the earning per share would likely increase, and that would affect the stock price positively. Stock price will equally, follow suit. You have investor optimism. And so in the bull market, there is often a heightened risk appetite among investors. People certainly acquire appetite for risk. I don't even know where they kept them in the first instance. They have that, they exhume that appetite for risk. And so small cap stocks begin, being more volatile and speculative, tend to attract investors looking for higher returns. So the market is like euphoric. There's euphoria everywhere. People are just looking for risk. As long as there's return, so they will take the risk to be able to acquire higher returns. And so this surge in demand can cause small cap stocks to outperform as some investors take on more risk. Suddenly, people tend to have higher risk tolerance. People's emotions are governed by market cycles. In a typical bull market where there's euphoria, they certainly, assume a risk level and dimensions that ordinarily wouldn't have really, been visible. So you have sector expansion. And small cap stocks often operate in emerging industries or niche sectors, which can experience rapid growth during period of economic expansion. But small, generally in the bull market, actually, bull market tends to provide the ideal environment for innovation and new market leaders to emerge. So small caps typically benefit the most when there's expansion in the economy. So small cap stocks will get the fertilizer to grow. They will have the catalyst to grow alongside the economy. So they tend to benefit during period of economic expansion. So number two here is underperformance in a bear market. We've just examined outperformance, in a bull market, which incorporate higher growth potentials, investor optimism, and sector expansion. This time around, I want to consider underperformance in the bear market, which include higher sensitivity to economic downturn, lack of stability, increased risk aversion, as well as access to capital. So number one here is higher sensitivity to economic downturn. So small cap stocks are more vulnerable during bear markets due to their limited financial resources and smaller market presence, as well as higher reliance on external funding. So they rely too much on funding from external sources. So in a downturn, they may struggle with cash flow issues, reduced consumer spending, and higher borrowing costs, leading to more significant decline in their stock price. With no availability of funding as is usually the case, so they are exposed to limited borrowing opportunity, and they do that at a higher cost. And this cost will eventually eat into their profits, and that could entail or lead to a decline in stock prices. Number two is a lack of stability. Lack of stability. Unlike large cap stocks, small cap companies are not as established, and they lack the potential, they lack that particular financial stability to weather prolonged market downturn. In the case where there's a prolonged bear market, discover that small cap stocks will not be able to withstand the negativity in the economic environment. You will find it very difficult to adjust. Then this is followed by increased risk aversion. Increased risk aversion. So in a bear market, investors become more risk averse and tend to move away from smaller, more volatile stocks, favoring safer, larger, and more stable investment. These are the investors that we that assume higher risk appetite during during a bull market. All of a sudden they develop cold feet and tend to be very conservative, quite risk averse compared to what they used to be. The same class of people, they change even their behavior because of the nature of the economy. Investors, they are really unpredictable, I'm telling you. Why? It's because human beings are not all that logical in their decision-making process. They're not logical at all. When fear comes in, greed comes in, discover that they're no longer themselves again. So the last one here is access to capital. Access to capital. So during bear markets, small cap companies may find it more difficult to raise capital, which can limit their ability to operate effectively, or capitalize on opportunities. So is that what happened during the global financial crisis? At first, there was that particular almost like free loan, no collateral, that kind of prime this thing, subprime loan. Whether you are qualified or not, come and get loan. You are from prison, you don't come out of prison, come and get loan. And when there was this that mortgage crisis, global financial crisis, the banks had to tighten their lending conditions. So it becomes from free money to difficult to get money. So in that kind of condition, you discover that the small caps will find it very difficult to even access funding. This increases their risk of underperforming as they may struggle to maintain operation or fund their expansion plan. So finance can gyrate. Nothing is really stable. It's just like this, fluctuate based on the prevailing conditions of the economy, and even by the nature of human beings, market participants, how they tend to react to all these conditions. So small cap stocks tend to outperform during bull market due to their growth potential, investor optimism, and exposure to expanding sectors. However, they also underperform in bear markets due to their heightened sensitivity to economic downturns, the lack of financial stability, and reduced investments, and reduce investor demand. The volatility of small cap stocks make them a higher risk, higher reward investments, with a return closely tied to their overall, to overall market conditions. So market conditions tend to influence virtually everything. It ought to be fundamental, but unfortunately, it's the human behavior and the market conditions that tend to influence everything when it comes to investing. But all the same, I would still advise to remain a fundamental investor. At the end of it all, when there's hope and despair, euphoria and gloom, when everything dies down, you discover that it is fundamental that will stand. All other ones are just passing phases, but fundamental earnings governs everything.